Chapter 20 Valuation and Pricing Properties Introduction. Objectives. In this chapter, we will discuss the value of property and the comparative market analysis process. At the end of this chapter, you will be able to 1. Describe and differentiate key valuation concepts, types of value, and principles of value. 2. Describe the components of a residential market analysis, including the types of properties used to derive analysis results. 3. Explain the characteristics and mechanics of the sales comparison, income and cost approaches to valuation. 4. Explain the general mechanics and steps involved in preparing a comparative market analysis. Key terms. There are a number of important terms in this chapter. Remember to pay particular attention to these terms when you see them. Appraisal, investment value, assessed value, market price, comparative market analysis, market value, cost, mortgage value, cost approach, obsolescence functional external, depreciation, plottage, direct cost, price, evaluation, sales comparison approach, income approach, valuation, indirect cost, value in use, insured value. The New York Bureau of Educational Standards requires that you spend 150 minutes studying the material in this chapter. Your course timer can be found in the upper right-hand corner of your screen. Appraisals. As we discussed in an earlier chapter, before giving a loan, mortgage lenders want to know the value of the property that will be the collateral for that loan, so they can evaluate the degree of risk they will face in giving the loan. Before taking the risk, lenders want some level of assurance that their repayment obligation will be honored. One of the best assurances of this is the knowledge that the mortgaged property will generate enough income to meet the loan commitment. A second level of assurance comes from knowing that the borrower can meet the financial obligations. If the lender has somehow misjudged the borrower or something unforeseen happens, the lender could be forced into foreclosure and must attempt to recover the principal through a sale. This possibility makes it even more important for the lender to have solid information on the property's loan-to-value ratio. Since the only real way to determine the value of a property is through an actual sale, the lender must rely on an appraisal of the property's value. An appraisal is an unbiased estimate of the nature, quality, value or utility of an interest in or aspect of identified real estate and related personality as of a certain date. It's important to stress again that an appraisal is just an estimation based on a collection of evidence and not an actual determination of the value of a property. Is a CMA an appraisal? A comparative market analysis is not an appraisal. CMAs are done by real estate licensees. We'll talk about CMAs in more detail later in this chapter. Appraisals are done by professional appraisers who are licensed to perform this activity. They collect data and apply the data using one or all of three approaches: sales comparison approach, cost approach, income approach. If they can, appraisers use all three approaches to value the subject property as a way to guard against errors and establish a range of value. However, each approach tends to give a more reliable estimate for a particular property type. We'll look at each approach in more detail later in this chapter. Valuation. Valuation is the process of estimating the value of an identified interest in specific property as of a given date. The purpose of valuation is largely to determine a property's market value, which we will talk about in a few minutes. Types of value. Appraisals are done to determine value. There are a number of different types of value, so the purpose of the appraisal will reflect the type of value sought. In addition to market value, other types of value are: investment value is the amount of the return on an investment that an income-producing property will produce. Insured value is the face amount a casualty or hazard insurance policy will pay in case a property is deemed unusable. Use value of a property is the value the property holds for the owner. Several factors contribute to this value. Income. Property can produce income through leases. This is important to value because investors will pay for the income flow that ownership brings them. Appreciation. Property generally increases in value over time. This is another investment benefit for an owner. Use. The specific use of a property determines its value and its benefits. Tax benefits. Property ownership could yield benefits and capital gains, tax losses, tax deferrals and depreciation for an owner. Mortgage value is the value the lender places on a property as collateral for the loan, especially in the event of a foreclosure when the lender must recover the debt through the sale of the property. Types of value. Other types of value include, but are not limited to, exchange value, the value that results from comparing the property to other similar properties on the open market. This is the type of value that real estate agents are concerned with. Reproduction value, the value based on the cost of constructing a precise duplicate of the subject property's improvements, assuming current construction costs. Replacement value, the value based on the cost of constructing a functional equivalent of the subject property's improvements, assuming current construction costs. Salvage value, the nominal value of a property that has reached the end of its economic life. Salvage value is also an estimate of the price at which a structure will sell if it is dismantled and moved. Assessed value, the value of a property as estimated by a taxing authority as the basis for ad valorem taxation. Condemned value, the value set by a county or municipal authority for a property which may be taken by eminent domain. Depreciated value, a value established by subtracting accumulated depreciation from the purchase price of a property. The value of the property can increase or decrease depending on whether the anticipated change is a benefit or a disadvantage. For example, a buyer hears that the property down the street may become a shopping mall. Is that a benefit or a disadvantage? It may depend on the buyer's viewpoint. Assemblage. When two adjacent pieces of property are joined together, the value of the one larger parcel may be greater than the value of the two separately. For example, two lots are valued at $25,000 each, but when combined for one use, they have a value of $60,000. The extra value created by merging the two parcels is called plottage value. Change. Both market conditions and a property's physical condition change constantly over time. These changes affect the benefits of the property. Using our shopping mall example again, is the construction of a mall a benefit or a detriment to the property's value? An appraiser needs to keep abreast of these types of changes. Principles of value. Conformity. This principle says that a property is at its highest value when it conforms with and fits into its surroundings. If a 3-bedroom, 1-bath home is in a neighborhood where all the homes have 2 bathrooms, it might be wise for the owner to consider installing a second bathroom. Competition. This principle holds that when several businesses of a similar type are close to one another, together they may make more money than they would have individually. For example, several fast food chain restaurants located on the same major street attract more buyers than one fast food restaurant would if it sat by itself. Contribution. This is what the market recognizes as the change in value an improvement makes to a property, rather than what that improvement actually cost. A remodeled kitchen might add $50,000 to the value of the home, while the actual cost could have been anywhere from $25,000 to $75,000. Diminishing return. This condition is a result of continuing to add improvements to a property when those improvements will have no effect on increasing the value of the property. Principles of value. Highest and best use. According to this principle, every property has a single use which produces the greatest income and return. Therefore, the property will have its highest value when it is used for that purpose. The property's use must be legally permissible, physically possible, financially feasible, maximally productive. For example, an old office building may not be in its highest and best use if it's located in a downtown area that is undergoing a residential redevelopment. Its best use might be a conversion to high-end condominium units. Progression and regression. This principle holds that a property is affected by the surrounding properties. The value of the smallest house on the block will tend to increase if the other homes on the street have more value. Progression. On the other hand, the value of the largest home on the block may decrease if the other homes on the street are much lower in value. Regression. Principles of value. Substitution. According to this principle, a buyer will not pay more for a home than what he or she would pay for another home that is equally attractive and available. For example, if there are several homes for sale in a neighborhood and they are alike in size, quality and amenities, a buyer won't usually purchase the home with the highest price. Supply and demand. This principle says that the value of a property depends on how many properties are available in an area. Property prices. Number of prospective buyers. Price buyers are willing to pay. For example, if there is only one home available in a highly desirable neighborhood, that home would probably have more value than it would if there were 4 homes for sale in that same neighborhood. Market value. Market value is the most probable price, as of a specific date, in cash, or in terms equivalent to cash, or in other precisely revealed terms, for which the specified property right should be sold after reasonable exposure in a competitive market under all conditions requisite to fair sale, with the buyer and seller each acting prudently, knowledgeably, and for self-interest, and assuming that neither is under undue duress. In other words, the market value of a property is the highest price a buyer is willing to pay and the lowest price the seller will accept. Under these conditions, the market is open and competitive. The property is exposed in the market for a reasonable period of time. Both buyer and seller are fully aware of market conditions. Both buyer and seller are acting with no undue pressure. Buyer and seller are not related. Both buyer and seller are aware of the property's potential for use. Both parties are aware of the property's assets and defects. The sale is a cash transaction. The property has a marketable title. The price does not include hidden aspects, such as service fees, credits, or special financing terms. Value versus price or cost. There is an important distinction between market value and market price. The market value of a property is an opinion of the value of a property based on analyzing data collected about the property. The analysis could include information about potential income and expenses to the property in addition to the analysis of comparable properties that have sold previously. The market price of a property is an amount a particular purchaser agrees to pay and a particular seller agrees to accept under the circumstances surrounding the transactions. In other words, the actual sales price. It would be ideal if the market value and the selling price were the same. However, in some circumstances they are not. If a seller is forced to sell because of a transfer, for example, the property could sell well below market value. On the other hand, a property could sell above market value if the price of the property includes personal property. The key to understanding the difference between market value and market price is that market value is an estimate of the price that would be paid in a typical transaction with a typical buyer and a typical seller. Market price is the actual price paid by a specific buyer and a specific seller in a specific transaction. Oftentimes people have the misconception that market value and cost are the same. This could be true with new construction. The cost to build a home may be equivalent to its market value. However, in many other cases, cost and market value don't correspond. For instance, a homeowner can spend $25,000 to finish the basement, only to discover that he or she has not added $25,000 to the value of the home and may never be able to recoup that cost at resale. 1. Explain the difference between market value and market price. 2. What does the term anticipation mean as it relates to property value? 3. Grace and Paul spent $75,000 on a complete remodel of their kitchen. What does this mean to the value of their home? 4. Explain the principle of substitution. Check your understanding, Answers 1. Explain the difference between market value and market price. Market value is an opinion of the value of a property based on analyzing data collected about the property. The market price of a property is the actual sales price and can in some circumstances be greater or lesser than market value. 2. What does the term anticipation mean as it relates to property value? The benefits a buyer expects to receive over the period of time he or she holds the property. 3. Grace and Paul spent $75,000 on a complete remodel of their kitchen. What does this mean to the value of their home? It depends on what the market recognizes as the change in value the improved kitchen makes. A remodeled kitchen might add $50,000, $75,000, or even $100,000 to the value of a home. 4. Explain the principle of substitution. Substitution says a buyer will not pay more for a home than what he or she would pay for another home that is equally desirable and available. Comparative Market Analysis. A CMA is done by a listing agent to give the seller information about the sales prices of similar homes, so the seller can decide how much to ask for the property. According to the principle of substitution, which we talked about earlier, a buyer will not pay more for a home than what he or she would pay for another home that is equally attractive and available. Therefore, if a seller is objective and reasonable, he or she will be amenable to setting a listing price that is based on the prices that buyers have paid for similar properties in the area. The agent will do a CMA to analyze the competition that a property will face in the marketplace when attempts are made to sell that property. When getting ready to do a CMA, a licensee will do the following. 1. Collect and analyze information about the seller's property. 2. Choose comparable properties in the area. 3. Compare the seller's property to the comparables and do some adjusting to the value of the comparables. 4. Estimate a reasonable and realistic selling price for the seller's property. A CMA resembles the sales comparison appraisal approach, which we will talk about later in this chapter. However, by law, a CMA may never be referred to as an appraisal. A CMA is only an opinion of selling price. Residential market analysis. Prior to preparing the CMA, the agent begins by doing a thorough residential market analysis of the subject property. When collecting information about the seller's property for analysis, the licensee should focus on the neighborhood, the home site, existing property improvements. Note: whatever information the licensee collects on the seller's property should also be collected on the comparable properties. Neighborhood location is a critical factor in determining value. So, the characteristics of the neighborhood can have a significant impact on the seller's property value. As you know, the value of the best house on the block can suffer if the neighborhood is poor or has deteriorated for any reason. Conversely, the value of the smallest or least desirable house on the block can be boosted by a good or sought-after neighborhood. Home site. The licensee should collect information about these features: property width, frontage, depth, area, shape, landscape, position and orientation, and title considerations, such as easements or encroachments. Property improvements. Most residential properties have a home with either an attached or detached garage. Some properties may also have a shed or other outbuilding on the property. Other data to look at includes quality of construction, age, home size, basement, energy efficiency, interior design features, and total number of rooms. Recently sold properties. Comparable properties that have recently sold are probably the best predictor of the market value of the seller's property. Since the transactions have closed and the seller has received his or her cash, it is safe to assume that the selling price was arrived at mutually by a willing seller and a willing buyer. This list of properties should include similar properties that have sold within the past 3 to 6 months. The more recent the sale, the more reliable the data. A licensee should include a minimum of 3 properties in this category. If there isn't enough data available, the licensee will have to increase the time frame. But keep in mind that the further back the sales go, the less reliable the data becomes and the more adjusting the licensee will have to do to account for changes in the market over that time period. This list shows the actual sales price for the property. Information about sold properties also shows the original listing price and the days on the market, which gives information about how competitive the home was in the marketplace at the time. As we said, this data should have the most impact on what the subject property is realistically worth in the current market. Current competing properties. Pending sales. These are homes whose offers have been accepted by the sellers, but the sale hasn't closed and the title has not transferred. Sales normally remain in the pending stage for 30 to 60 days. A licensee should keep in mind that the information on pending sales is not as reliable as on sold homes because the price the licensee sees on the pending home is the listing price, not the final sale price. The definite sale price of the home won't become available to the licensee until the sale actually completes. Many times the sale price is somewhat lower than the listing price, or in some cases, it could be higher. The sale is not complete until it's complete. In other words, something could still happen to overturn the sale even up to the very last minute before closing. The buyer could choose to walk away or the lender could deny financing for one reason or another. If the pending comparable is a very close match to the home the licensee is trying to list, he or she can contact the listing agent for the pending sale and see if the agent would be willing to give out any information as to whether the home sold close to the asking price. The agent cannot give out the actual final price because that would be a violation of the agent's fiduciary duty to the seller, but the agent might be able to give enough general information to be helpful. Current competing properties. Active listings. Sellers are always interested in knowing the listing prices of the comparable homes currently for sale in their area. While this is understandable and the licensee needs to present this information, it should also be accompanied with some sound advice. Sellers need help in keeping their expectations realistic. A licensee should take these steps with the seller. Make it clear to the seller that the current asking prices will be affected by the negotiations between the sellers and the ultimate buyers of the homes. Rarely does a home sell at or even close to the original listing price. Tell the seller that the current active listings show the level and intensity of the competition for homes that are comparable to the seller's home. Explain to the seller that while he or she has only one home to sell, the buyers have a number of homes to choose from. The active listings give an indication of how each of the homes currently on the market stacks up against one another. Recently expired properties. These are the homes comparable to the seller's home that ultimately did not sell. These homes are the opposite end of the spectrum from the homes that sold. Most often a property fails to sell because of overpricing. Expired data may show the seller that the asking prices of these homes were significantly higher than the selling prices of the homes on the recently sold list. This is powerful information for a licensee to share with a potential seller. This information can support suggestions for a more realistic listing price. The licensee can also argue that setting an asking price that is too high will waste valuable time as securing the sale for the owners. If a licensee can find one, a particularly good example to share with a seller would be that of an expired listing that had been relisted and is now on the sold properties list. This will illustrate rather graphically how the home was originally overpriced and failed to sell, but when relisted at a price that was on target, it sold readily. Residential market analysis. Other considerations. Buyer appeal. This is a very subjective issue. Some homes appear larger than other homes from the outside, but actually have the same amount of square feet inside. In a case like this, the larger-looking home may be more appealing to a buyer. Homes that are set further back from the street may be more appealing to some buyers, while homes with professional-looking landscaping may be more appealing to other buyers. Market position. This refers to how many similar properties may be for sale at the same time in a particular market. The licensee must be able to show how the subject property differs from the similar properties and market those differences in a positive way. Assets. Most buyers want to purchase property that is in good condition, is in a desirable location, and has a good traffic flow. For some buyers, a cul-de-sac location is more desirable because of the low traffic patterns. Drawbacks. On the other hand, properties in high traffic or noisy areas may be less desirable. Other negative aspects of a property could be problems with landscaping or being too close to the neighboring properties. Residential market analysis. Other considerations. Area market conditions. As we all know, the market conditions change periodically based on such things as the economy, supply and demand, and the seasons. As we said earlier, the principle of supply and demand says that the value of a property depends on how many properties are available in an area, property prices, number of prospective buyers, and the price buyers are willing to pay. Seasonal factors revolve around holidays, weather conditions, and the start of school. Recommended terms. The listing price of a property is really only one aspect of a quick sale. Of course, it's important to price the property correctly, but there are other considerations that influence a home sale. Possession date. Will it be immediate, or will there be a delay for some reason? Contingent sale. Do the buyers have a property to sell before they can complete this sale? Financing terms. Are interest rates good? Can the mortgage be assumed? Can the sellers finance all or part of the loan for the buyers? Market value range. When the agent has completed a comparison of several properties against the seller's property, he or she can come up with a range of value to present to the sellers that will assist them in arriving at a reasonable and appropriate listing price. If upon presentation of the suggested price range the sellers are reluctant to set the listing price within the range, it would probably be wise for the licensee to refuse to market the property. Homes that are not priced according to the current market conditions do not sell very quickly. Salesperson's role. When doing the residential market analysis, the licensee has a number of responsibilities. Competence. Being able to market property competently is an important aspect of a licensee's job. The licensee should be able to answer the client's questions regarding all aspects of the market analysis that he or she has prepared. If there are questions the licensee cannot answer, he or she should seek help from the broker. Diligence. Once a licensee has secured a listing, he or she must do all that is possible to market the property. This includes performing all aspects of advertising, seeking the feedback of agents that have shown the property, evaluating the feedback received, and communicating regularly with the sellers. Documentation. It's important to keep records of who has shown the property from the licensee's office and from other offices. It's also important to keep lists of those who have attended agent open houses and public open houses. The licensee should also keep track of the pending sales and the active listings of the homes that he or she included in the CMA. The results of those sales may give the licensee critical information regarding whether or not the list price of this property may need to be adjusted. Effective communication. It has been shown that the major complaint sellers have with their agents is poor communication. It is crucial for licensees to provide frequent updates to their sellers about the activity on the property and to do so in a professional manner. It is also important for licensees to get feedback from other agents about the showings and to communicate that information to the sellers. Highest and best use. As we discussed earlier, according to the principle of highest and best use, every property has a single use which produces the greatest income and return. Therefore, the property will have its highest value when it is used for that purpose. Highest and best use as vacant and as improved. The test of highest and best use is applied to an improved property both as improved and as vacant. Vacant properties are generally only given the as vacant test. The highest and best use as vacant may be the same as or different from the highest and best use as improved. For example, Home 1 is in an area that is zoned residential. This home may have a highest and best use as vacant and a highest and best use as improved that are both residential. Home 2 is similar to Home 1, but it is located in a commercially zoned area. Home 2 single quote S highest and best use as vacant may be as a commercial lot, and its highest and best use as improved may be a single-family residence. If the value of house 2 as vacant is greater than the value of house 2 as improved, the overall highest and best use of this property could be as a commercial lot. It would depend on the costs of demolishing the house. Consider this scenario. Let's assume that house 2 has a site value as a commercial lot of $250,000. If the house itself has a value of $200,000, and the cost to demolish it is $25,000, the highest and best use of the site is to demolish the house and sell the site as a commercial lot. However, if the demolition costs were $55,000 instead, the highest and best use would be the existing residential use, because the value as a commercial lot would not exceed the existing value as a residence. Site valuation. A site is an area or plot of ground with defined limits on which a building or project is located or proposed to be located. When a site is unimproved, studies are usually done to determine its highest and best use and its ultimate ability to be sold. Studies can include feasibility, cost of development, financing concerns, tax considerations, rate of return, benefits to the community. When doing a site valuation, the developer looks at the total usable square footage of the parcel, in other words, those areas of the parcel that will produce income for the developer. Other areas of the parcel include the streets, sidewalks, utilities, green spaces and recreational areas. Check your understanding. Print this screen, answer the questions and then advance to the next screen to see the answers. 1. When collecting information about the seller's property for analysis, what should a licensee focus on? 2. What important information can a licensee glean from sales price, original price and number of days on the market when looking at sold properties? 3. Of what value are expired listings to a CMA and what would be a particularly good example of one? 4. What terms besides selling price should be important considerations that influence a home sale? Check your understanding. Answers 1. When collecting information about the seller's property for analysis, what should a licensee focus on? The neighborhood, the home site, existing property improvements. 2. What important information can a licensee glean from sales price, original price and number of days on the market when looking at sold properties? This data gives information about how competitive the home was in the marketplace at the time. 3. Of what value are expired listings to a CMA and what would be a particularly good example of one? Expired data may show the seller that the asking prices of these homes were significantly higher than the selling prices of the homes on the recently sold list. A particularly good example to share with a seller would be that of an expired listing that had been relisted and is now on the sold properties list. 4. What terms besides selling price should be important considerations that influence a home sale? Possession date, contingent sale, financing terms. 3 approaches to value. As we mentioned earlier in this chapter, there are 3 approaches to estimating value that appraisers use. Sales comparison approach, cost approach, income approach. The sales comparison approach is based on the principle of substitution, which says that a buyer will not pay more for the subject property than he or she would pay for a property that is similar in characteristics and amenities. With this approach, the value is determined by comparing the property being appraised with recently sold comparable properties. Since no 2 properties are exactly alike, the appraiser must compare the similarities and differences among the properties and then make adjustments to the sales prices of the comparable properties to account for the differences. The appraiser makes adjustments to the comparable properties because the sale prices for those properties are known, while the sale price for the subject property is still an unknown. The appraiser makes adjustments to the comparables by either adding value or deducting value. If the comparable is better than the subject property, some amount is deducted from the sale price of that home. For example, if the comparable is a 4-bedroom, 2-bath home and the subject is a 3-bedroom, one-bath home, the appraiser will deduct an amount, say $15,000, from the sale price of the comparable to equalize the difference. Conversely, if the comparable is inferior to the subject property, some amount is added to the sale price of that home to equalize the difference. Sales comparison approach. Appraisers make the adjustments based on these criteria. Date of sale. The appraiser must make an adjustment if there are economic changes in the market between the date the comparable sold and the date of the appraisal. Location. If there is a difference between the comparables and the subject's location, the appraiser must make an adjustment. The different locations could even be within the same neighborhood. Physical characteristics. The appraiser must also adjust for differences in such amenities as number of rooms, total square footage, presence or absence of a fireplace or garage, age, construction type, landscaping or other similar features. Transaction characteristics. The appraiser must consider financing terms, such as the mortgage loan terms or owner financing. Sale conditions. If the sale was a foreclosure or a sale between family members, the appraiser must make adjustments for those conditions as well. The sales comparison approach is deemed to be the most reliable for appraisals of single-family homes. Most appraisers compare from 3 to 6 homes, but usually include only 3 in the appraisal report. Some appraisal forms want currently listed similar properties included in the appraisal also. Sales comparison approach. Example: Meredith and Dwayne Johnson want to sell their home. Here is an example of how an appraiser might arrive at their home's value using the sales comparison approach. Subject property: A BC sale price $125,000, $129,500, $135,000. Financing standard date of sale current location good age 10 years lot size 70 x 200 larger. Construction type brick construction style 2-story £, of rooms 8, £, of bedrooms 3 4, £, of bathrooms 1.5 2 total square feet 1,800 other space basement garage 2 car none exterior condition good interior condition good better improvements none landscaping good net adjustments plus $4,000 minus $1,000 minus $5,500 adjusted value $129,000 $128,500 $129,500 based on the fact that all 3 comparables adjusted to very close values and the fact that comparable B had only one adjustment. The appraiser would probably value the Johnsons' property at $128,500. Cost approach. The cost approach is most reliable for properties that were built recently, since the appraiser can get access to the actual costs of the development and construction. It's also a good approach for special purpose buildings when data on income is not available or there are no comparable sales. The cost approach attempts to estimate either the property's replacement cost or reproduction cost. Reproduction cost is the construction cost at today's prices of producing an exact duplicate of the current building, including its improvements and its flaws. Replacement cost is the construction cost at today's prices of producing a similar or equivalent structure. This method is most popular when appraising older buildings with outdated features. Newer materials and techniques can replace the outmoded ones. The cost approach has 5 steps. 1. Estimate the value of the land. 2. Estimate the cost of improvements, either replacement or reproduction cost. 3. Estimate the accrued depreciation that results from physical deterioration, functional obsolescence or external obsolescence. 4. Subtract the depreciation total from the estimated cost of improvements. 5. Add the land value to the depreciated cost to get the total estimated value of the property. Let's discuss the first 3 steps in a bit more detail. Cost approach. Step 1 Estimate land value. This step is usually done using the sales comparison approach we discussed earlier. The appraiser compares the location and any site improvements such as utilities and sewer lines of the subject property with those of similar nearby sites. The appraiser will then make adjustments for any significant differences. Step 2 Estimate cost of improvements. Reliable data is usually easy to obtain in this area. An appraiser can collect the information from builders in the area, deduce the data from actual costs of recently constructed buildings, or obtain estimates from computerized cost estimating services. When computing the reproduction or replacement cost of a building, an appraiser would use one of these four methods. 1. Unit comparison method. An appraiser examines at least one newly constructed building that is similar to the subject property and computes the cost by multiplying the cost per unit by the number of units. The unit of measurement is usually square feet, but in some cases it could be cubic feet. This is typically the most common and easiest to use method. 2. Unit in place method. The appraiser estimates the cost of individual components, such as materials, labor, overhead and profit. He then adds together the individual estimates to arrive at the overall cost. 3. Quantity survey method. This method is a detailed estimate of all materials, labor, supplies, overhead and profit. It is more thorough than the unit in place method, but is also very time-consuming. Because of its detail, it's not often used by appraisers, but is used by contractors and experienced estimators. 4. Index method. The appraiser applies a percentage increase factor to the original cost of construction to account for the increases in costs over time. Cost approach. Step 3 Estimate depreciation. In real estate, depreciation refers to a loss in value of a property due to any cause. Depreciation can be curable or incurable. For appraisal purposes, depreciation is divided into three classes according to cause. Physical deterioration, decay or disintegration, cracks, settling, structural defects, termite damage. A curable item, such as painting, would probably be economically feasible and would result in an increase of value that would equal or exceed the cost of doing it. An incurable item is one that may not be economically feasible to correct or would not contribute a comparable value to the building, such as replacing siding on a building. Functional obsolescence. Within the property lines, outdated plumbing, electrical or heating, outmoded lighting fixtures or architecture. A curable item is a design feature that is no longer desirable but could be replaced at a cost that would be balanced by the increase in value it provided, such as replacing bathroom fixtures or converting a bedroom near a kitchen into a family room. Alternatively, an incurable item is a design feature that cannot be cost-effectively replaced, such as a large office building that cannot be air-conditioned. External obsolescence. Outside the property lines, population changes, neighborhood changes that decrease value, legislative changes. These types of defects are caused by negative environmental, social or economic factors and are usually incurable because spending money on the property would not affect the loss in value caused by these factors. For example, a subject site close to a factory that pollutes suffers from a defect that the subject site owner is powerless to correct. Cost approach. To determine depreciation, many appraisers use the breakdown method. This method breaks the depreciation down into the three classes and gives estimates for the curable and incurable factors of each class. However, depreciation is hard to estimate, especially for older buildings. So, appraisers tend to use the straight-line method to estimate accrued depreciation because it is easier than the breakdown method, but it's also less precise. The straight-line method is also called the economic age-life method and assumes that depreciation occurs at a steady rate over the economic life of the property. This method is primarily useful when estimating depreciation from physical deterioration. The economic life is that time period that a building is expected to remain useful for its originally intended purpose. The cost of the building is divided by the number of years of its economic life, and the result is the annual depreciation amount. For example, a property costs $150,000. The land value, which does not depreciate, is $40,000, leaving $110,000 as the value of the building. The building has an expected economic life of 50 years, so the annual depreciation would be $2,200. Cost approach. Now that we discussed the cost approach, let's look at Meredith and Dwayne Johnson's home again using the cost approach. Land valuation $33,000. Building valuation replacement cost 1,800 square feet at $65 per square foot equals $117,000 less depreciation. Physical depreciation, curable paint outside $6,000. Tuck pointing $1,000, new roof $3,000. Incurable $9,000, functional obsolescence $2,000, environmental external economic obsolescence $0 less, total depreciation minus $21,000, total depreciated value of building $96,000, total land valuation $33,000, depreciated value of building plus $96,000, total value of property cost approach $129,000. 00. As you can see, the estimated value of $129,000 is very close to the $128,500 estimate arrived at using the sales comparison approach. Income approach. Appraisers use the income approach to estimate the value of properties that produce income, usually from rent paid on leases. This approach assumes that an investor will purchase a property based on the future income stream the property will produce, the principle of anticipation that we discussed in an earlier chapter. This approach also assumes that an investor will not pay any more for a property with a certain income than he or she would pay for a similar property with a similar income, the principle of substitution. Investors themselves use this approach to determine how much they will pay for an apartment building, office building, shopping mall, or some other like property. The downside to this method is that it is often difficult to determine an appropriate capitalization rate, and the needed information about income and expenses can be hard to find. The income approach has 5 steps. 1. Estimate the potential gross income. 2. Estimate the effective gross income. 3. Estimate the net operating income. 4. Select a capitalization rate. 5. Apply the capitalization rate. Let's look at each step in detail. Income approach. Step 1. Estimate the potential gross income. The potential gross income is the rent scheduled to be collected on the property plus income from such other sources as vending machines, parking fees, and laundry facilities. The scheduled rent is the amount of rent the property will collect if it is fully leased at the current rental rates. An appraiser should also use market studies to estimate the rental income, since the current rent for a particular property may not reflect the current rates of the market in general. Step 2. Estimate the effective gross income. An appraiser calculates effective gross income by subtracting vacancy and credit losses from potential gross income. Vacancy losses are the amount of income lost because of space that's not rented. Credit losses are the result of tenants not paying the rent. The appraiser estimates vacancy and credit losses based on the property's history and other properties in the market that are comparable. Step 3. Estimate the net operating income. An appraiser arrives at net operating income by deducting annual operating expenses from effective gross income. Operating expenses can be both fixed and variable. Fixed expenses include such items as taxes and insurance, those items that are not affected by the presence or absence of renters. Variable expenses relate to actual operating expenses, such as utilities and repairs. Note: the mortgage is related to the debt on the property, so mortgage payments are not operating expenses. Income approach. Step 4. Select a capitalization rate. An appraiser arrives at the capitalization rate by comparing the relationship of net operating income to the sales price of similar properties that have recently sold. The capitalization rate is defined as the rate of return an investor will require on his or her investment of capital in this kind of property. For example, a property similar to the subject property recently sold for $220,000. The building is producing an annual net operating income of $25,000. Income divided by value equals capitalization rate. $25,000 divided by $220,000 equals 11%. If the appraiser determines that other comparable properties sold at prices that yielded equivalent rates, then the appraiser would apply the capitalization rate of 11% to this property. Step 5. Apply the capitalization rate. In this final step, the appraiser divides the estimated net operating income for the property by the arrived at capitalization rate, and the result is the estimated value of the property. Net operating income divided by capitalization rate equals value. For example, $20,000 income divided by 8% cap rate equals $250,000. $20,000 income divided by 7% cap rate equals $285,714. Note, as the capitalization rate goes down, the value goes up. Income approach. Here is an example of an appraisal using the income approach. Potential gross annual income $80,000, additional income plus $9,000, $89,000. Less vacancy and collection loss minus $4,450. Effective gross annual income $84,550. Expenses: real estate taxes $8,000, insurance $1,500, heat $3,800. Maintenance $6,000, utilities $1,800, repairs $2,500, decorating $1,000, legal and accounting $900, management $4,500. Total expenses $30,000, net operating income $54,550. Capitalization rate equals 10%. Value $545,500. Let's look at a second example on the next screen. Income approach. Let's assume that a buyer is interested in purchasing Meredith and Dwayne Johnson's home as a rental investment. Here's what the appraisal might look like using the income capitalization approach. Potential gross annual income $10,800, additional income plus 0. $10,800 less vacancy loss minus 0. Effective gross annual income $10,800. Expenses: real estate taxes $1,500, insurance $750, repairs $800. Total expenses $3,050, net operating income $7,750. Capitalization rate equals 6%. Value $129,166. You can see that using this approach gives us a value that is comparable to the $128,500 value from the sales comparison approach and the $129,000 value from the cost approach. However, since this method is least effective for a single-family residence, it would not carry as much weight as the other appraisal methods. Check your understanding. Print this screen, answer the questions, and then advance to the next screen to see the answers. 1. The sales comparison approach is thought to be the most reliable appraisal approach for what kind of property? 2. What's the difference between reproduction cost and replacement cost? 3. Jim is using the cost approach to appraise Greg's property. John has the following figures: land value $25,000, building value $137,500, total depreciation $33,000. Using these figures, what will John estimate as the total value of the property? 4. The income approach is based on which two principles of value? Check your understanding. Answers: 1. The sales comparison approach is thought to be the most reliable appraisal approach for what kind of property? The sales comparison approach is thought to be the most reliable for appraisals of single-family homes. 2. What's the difference between reproduction cost and replacement cost? Reproduction cost is the cost at today's prices of producing an exact duplicate of the current building, including its improvements and its flaws. Replacement cost is the construction cost at today's prices of producing a similar or equivalent structure. 3. Jim is using the cost approach to appraise Greg's property. John has the following figures: land value $25,000, building value $137,500, total depreciation $33,000. Using these figures, what will John estimate as the total value of the property? $129,500. 4. The income approach is based on which two principles of value? Anticipation and substitution. Preparing the CMA. As we said earlier in this chapter, an agent will do a CMA to analyze the competition that a property will face in the marketplace when attempts are made to sell that property. When getting ready to do a CMA, a licensee will do the following. 1. Collect and analyze information about the seller's property. 2. Choose comparable properties in the area. 3. Compare the seller's property to the comparables and do some adjusting to the value of the comparables. 4. Estimate a reasonable and realistic selling price for the seller's property. We have already discussed what kinds of data to collect about the subject property. We also talked about choosing comparables from among the recently sold, pending, active and expired listings in the area. Once the licensee has chosen comparable properties in each category, he or she will compare each of them to the seller's property. The licensee makes the comparison based on location, physical characteristics, sale date, and financing terms. The licensee will use the differences in those factors to make small adjustments to either the sale price or the listing price of the comparables. Note: the licensee will always be making the adjustments to the comparables. He or she should never try to make any adjustments to the perceived value of the seller's property. Adjusting the comparables. If one of the comparables happens to be identical to the seller's property in location, physical characteristics and financing terms, and it also happened to have sold within the previous month, the licensee would have a valuable indicator of what the seller's property is worth in the market right now. The licensee would not have to make any adjustments to that comparable. However, such a situation rarely takes place, except possibly in new housing developments where the builders are building a number of homes with identical floor plans. What happens more often is that the comparables and the seller's property have at least one or even several significant differences that the licensee will have to adjust. Consider this situation. Agent Jim has found a comparable in the same neighborhood as his seller's property. Almost all the factors are the same, except that the comparable has 3 full bathrooms and the seller's home has 2 full baths. The comparable sold for $250,000. Since the comparable has a feature that the seller's home does not have, Jim will need to adjust the sale price of the comparable downward to make up for the difference. Adjusting the comparables. The licensee will determine an estimated value for specific home features and will either add or subtract those values from the sale or listing price of the comparables. If a comparable lacks a feature that the seller's property has, for example, the comparable has 1 less bathroom than the seller's property, the licensee will add the value of the feature to the price of the comparable. If a comparable has a feature that the seller's property does not have, for example, an extra bedroom, the licensee will subtract the value of that feature from the price of the comparable below as a sample chart that illustrates how the adjustments are done. Comparable sales comparison chart features seller's property comparables 1, 2, 3. Sale price $141,500, $152,750, $169,750. Location Greenwood Lot size 80x195 larger. Age 12 years Style 2-story Bedrooms 3 2 4. Bathrooms 2 3 3. Total rooms 7. Square feet 1,800 Exterior good Garage 2 car none Basement unfinished Financing. Days on market Total adjustments plus $8,500 minus $4,500 minus $13,000 adjusted value $150,000 $148,250 $156,750 estimating a reasonable selling price. If you look at the bottom of the chart on the previous screen, you can see that each comparable now has an adjusted market value price. These are the figures that a licensee would use to estimate the value of the seller's property. But before the licensee comes up with an estimate, he or she needs to evaluate the soundness of each comparable. The most reliable comparables would be those that are the most similar to the seller's property, in this case, most similar meaning the fewest number of adjustments. So, in our example above, comparable 3 is the least reliable, since it has several adjustments. Comps 1 and 2 are much more similar to the seller's property, with comp 2 being the closest. So, the licensee would give the most weight to comp 2 and the least weight to comp 3. It's not up to the licensee to provide the seller with an exact listing figure. The licensee should give the seller a listing range, and then the seller can set the price to whatever he or she feels comfortable with within that range. So, in our example above, our licensee might suggest a listing price that falls within the range of $147,500 to $153,000. CMA walkthrough. Now that we've discussed all the steps involved in doing a CMA, let's take some time to walk through a scenario in detail. Please keep in mind as we process through the steps that the information we are using here is much more simplified than what you will find out in the real world. You will find variations and complexities that are beyond the scope of our course goals here, and you will likely need to get advice from more experienced agents. As time goes on, however, you will become more experienced and be able to complete CMAs for your clients with ease and confidence. Here's your situation. Scenario: you are hoping to list a home for Tim and Sue Harris. Before they will commit to giving you the listing, they want your opinion of what their home would be worth on the current market. If they like the results of your analysis, they'll list with you. Now let's process through the steps to do the CMA for Tim and Sue. CMA walkthrough. Step 1. Collect and analyze information about the seller's property. You arrange to meet with Tim and Sue to spend some time walking through their home and property. As you tour the home, you ask the sellers questions about their time frame for moving and why they want to sell. You take copious notes about the home's features and faults. After all your questions have been answered, you leave the home and drive through the local neighborhood, sizing up the features and benefits as well as any noticeable shortcomings. As you drive through the neighborhood, you also look for homes that are currently for sale or have sold signs in the yard. You get back to your workplace and comb through all the information you collected. This is what you have gleaned. The Harris home is located in the Woodland Acres subdivision, which is an area for up-and-coming families just west of a busy metropolitan downtown business district. The Harris home was one of the first homes built in this subdivision, which is still growing and expanding. Several lots are still available and new construction is ongoing. The home has 4 bedrooms, 3 full bathrooms, a formal dining room, a full unfinished basement and a large, fenced backyard. The home is 2 stories and has an attached 3-car garage. The home is 3 years old and is in excellent condition. CMA walkthrough. Step 2. Choose comparable properties in the area. Now that you have organized the information about the Harris home, you try to find some comparable properties in the neighborhood. You look through your own files, check with fellow agents and check out the listings on your local MLS database. Once you have located several that look promising, you collect information about each of those homes. You walk through any of the homes that are currently listed and drive by the ones that have sold, whose sales are pending, or that have expired. After doing your analysis of the possible comparables, you settle on these 5, which are all in the same neighborhood, are 2 stories and are in excellent condition. Comparable age: beds, baths, dining yard, garage. Status: price 1, 2, 3, 3Y large, Back 3 at active $352,750 to 3, 4, 3Y large side 2 at sold 3 months ago $345,250 3, 3, 4 and 4 large back 3 at sold 6 months ago $355,000 4, 2, 4 and 2 large back 2 at expired $350,500 5, 4, 3, 3Y large back 3 at pending $340,500 CMA walkthrough. Step 3. Compare the seller's property to the comparables and do some adjusting to the value of the comparables. Once you have chosen your comparables, you'll compare each of their features to the features of the seller's property. The chart below shows the comparison of the properties. The differences are shaded. Seller comparables 1, 2, 3, 4, 5. Age 3, 2, 3, 3, 2, 4. Bedrooms 4, 3, 4, 4, 4, 3 bathrooms 3, 3, 3, 4, 2, 3. Dining room YYYNNY yard large back large side large back garage 3 at 2 at 2 at 3 at status active sold expired pending price $352,750 $345,250 $355,000 $350,500 $340,500 You will make adjustments to account for these differences. 3 bedrooms versus 4. 2 bathrooms versus 3. 4 bathrooms versus 3. Dining room versus no dining room. 2-car garage versus 3-car garage. You'll use these estimates. Bedroom equals $8,500. Bathroom equals $11,000. Dining room equals $5,500. Garage equals $6,500. CMA walkthrough. Now you make the adjustments to the comparables and the result looks like this. Seller comparables 1, 2, 3, 4, 5. Market value $352,750 $345,250 $355,000 $350,500 $340,500 Bedroom 4 3 = 3 plus $8,500 plus $8,500. Bathroom 3 = 4, 2 = minus $11,000 plus $11,000. Dining room Y = NN = plus $5,500 plus $5,500. Garage 3 at = 2 at 2 at plus $6,500 plus $6,500. Total adjustments plus $8,500 plus $6,500 minus $5,500 plus $23,000 plus $8,500 adjusted value $361,250 $351,750 $349,500 $373,000 $349,000 Status active sold expired pending. As you know, the actual sales price of a property is a much better indicator of value than the listing price. Given that, comparables 2 and 3 are the most reliable indicators of market value. Upon further analysis, you draw the following conclusions. Comparable 2 is more reliable than comparable 3 because there was only one differential, and a garage probably has less importance to a home's value than a bedroom or a bathroom would have. Comparable 1 is still active, so it probably represents the upper limits of value in this market. Comparable 4 had the most adjustments, so it is the least reliable of the group. In addition, the listing expired without a sale, and in looking at the adjusted value you can easily conclude that the home was overpriced. The sale of comparable 5 is pending, and you don't know the actual sale price. However, since its adjusted value is close to the value of the sold properties, it's probably safe to assume that the final sale price is close to the listing price. CMA walkthrough. Step 4. Estimate a reasonable and realistic selling price for the seller's property. Now that you've done your analysis work, You're ready to make an estimate of selling price for the seller's property and present your findings to the sellers. You decide that the property is worth about $351,000. You meet with the sellers and present them with a range of values, from $349,000 to $353,500. You explain how you arrived at that range, showing them the data you collected and describing the differences for each comparable. The sellers consider all the data and decide to list their property with you at a price of $353,000. Now that we have walked all the way through the CMA process, let's talk about a typical CMA form you might use. Click here to open and print a blank CMA form. When you are done, proceed to the next screen for an explanation of this form. Comparative Market Analysis form. This is a standard CMA form. It's straightforward and easy to use and shows all the information you would want to provide to a seller when you do your presentation. All of the features that are commonly used to compare one property with another are listed across the top of the form. Under the subject heading is a row to add all the pertinent information about the seller's property. The first section of the form under the Comparables heading allows entries of information on the homes that are currently listed. The prices associated with the active listing show what a buyer in today's market might pay for a similar home. You'll want to list the homes you found that are the most like your seller's property, but don't list more than 5. In the second section, you'll enter the information about homes that have sold within the past year. These prices show what buyers have actually paid for similar homes. List the homes in date order, with the most recent first. Again, list only 5 or less. The third section deals with pending sales. Remember that the prices shown here are the listing prices, not the actual sales price. Even though you don't know the final figures, it is positive for the sellers to have information about similar homes that are ready to be closed. The last section under Comparables is for any expired listings. The prices here are particularly important to illustrate what buyers would not pay for a similar home. You don't need too many of these to make the point. The bottom of the form has space for other miscellaneous information about the seller's property. Comparative Market Analysis form. The use of a CMA form like the one we just reviewed could go a long way in correcting any misconceptions the sellers might have about market values in their neighborhood. It's an agent's best ally in helping the sellers set a realistic listing price. The form we just presented is just one variation of standard forms that may be available. If your broker has a form that he or she prefers, please use it. It may have some variations in format or layout, but overall it should have all of the same pertinent information. Alternatively, you can use a computer program to produce a CMA. Your broker may have such a program available in the office. In some cases, CMA programs are available through the local MLS service, which could help simplify the search, since all of the properties in the MLS database would be available for the program to run against. Check your understanding. Print this screen, answer the questions and then advance to the next screen to see the answers. 1. How would you go about collecting information on a seller's property in preparation for doing a CMA? 2. Where will you find homes that are comparable to the seller's home you're wanting to list? 3. After collecting and organizing all the information on the seller's property and some number of comparable properties, what will be your next steps to complete the CMA? 4. To what properties does the licensee make adjustments when doing a CMA? Check your understanding. Answers 1. How would you go about collecting information on a seller's property in preparation for doing a CMA? Tour the home, taking notes about the home's features and faults. After getting answers to all questions, leave the home and drive through the local neighborhood, sizing up the features and benefits as well as any noticeable shortcomings. While driving through the neighborhood, look for homes that are currently for sale or have sold signs in the yard. 2. Where will you find homes that are comparable to the seller's home you're wanting to list? You will find homes in the same neighborhood by looking through your own files, checking with fellow agents, and checking out the listings on your local MLS database. 3. After collecting and organizing all the information on the seller's property and some number of comparable properties, what will be your next steps to complete the CMA? Estimate the values for the differential features, adjust the comparables. Estimate a price range, present the data to the seller for. To what properties does the licensee make adjustments when doing a CMA? The licensee will always make the adjustments to the comparables, never to the perceived value of the seller's property. Summary review. This concludes Chapter 20. Below is a summary which you can review before taking your quiz. An appraisal is an unbiased estimate of the nature, quality, value or utility of an interest in or aspect of identified real estate and related personality as of a certain date. Valuation is the process of estimating the value of an identified interest in specific property as of a given date. The purpose of valuation is largely to determine a property's market value. There are a number of different types of value. Investment value, insured value, use value, mortgage value, exchange value, reproduction value, replacement value costs, salvage value, assessed value, condemned value, depreciated, rental value. Summary review. Summary. Evaluation is a study of the nature, quality, or utility of certain property interests in which a value estimate is not necessarily required. Evaluation of a property does not result in an estimate of value. Evaluation looks at a number of economic principles that influence the value of a property. Economic principles that influence value include anticipation, assemblage, change, conformity, competition, contribution, diminishing return, highest and best use, progression and regression, substitution, supply and demand. Summary review. Summary. Market value is the most probable price, as of a specific date, in cash, or in terms equivalent to cash, or in other precisely revealed terms, for which the specified property rights should be sold after reasonable exposure in a competitive market under all conditions requisite to fair sale, with the buyer and seller each acting prudently, knowledgeably, and for self-interest, and assuming that neither is under undue duress. There is an important distinction between market value and market price. The market value of a property is an opinion of the value of a property based on analyzing data collected about the property. The market price of a property is an amount a particular purchaser agrees to pay and a particular seller agrees to accept under the circumstances surrounding the transactions. In other words, the actual sales price. People often have the misconception that market value and cost are the same. This could be true with new construction. However, in many other cases, cost and market value don't correspond. A comparative market analysis is not an appraisal. A CMA is done by a listing agent to give the seller information about the sales prices of similar homes, so that the seller can decide how much to ask for the property. According to the principle of substitution, a buyer will not pay more for a home than what he or she would pay for another home that is equally attractive and available. Summary review. Summary. When getting ready to do a CMA, a licensee will do the following. 1. Collect and analyze information about the seller's property. 2. Choose comparable properties in the area. 3. Compare the seller's property to the comparables and do some adjusting to the value of the comparables. 4. Estimate a reasonable and realistic selling price for the seller's property. When collecting information about the seller's property for analysis, the licensee should focus on the neighborhood, the home site, existing property improvements. Once the licensee has chosen comparable properties in each category, he or she will compare each of them to the seller's property. The licensee makes the comparison based on location, physical characteristics, sale date and financing terms. The licensee will use the differences in those factors to make small adjustments to either the sale price or the listing price of the comparables. Before the licensee comes up with an estimate, he or she will evaluate the soundness of each comparable. The most reliable comparables would be those that are the most similar to the seller's property, most similar meaning the fewest number of adjustments. The licensee will then give the seller a listing range, and the seller can then set whatever price he or she feels comfortable with within that range. Summary review. Summary: there are three approaches to estimating value that appraisers use. Sales comparison approach, cost approach, income approach. The sales comparison approach is based on the principle of substitution. With this approach, the value is determined by comparing the property being appraised with recently sold comparable properties. The sales comparison approach is believed to be the most reliable for appraisals of single-family homes. The cost approach is most reliable for properties that were built recently, since the appraiser can get access to the actual costs of the development and construction. It's also a good approach for special-purpose buildings when data on income is not available or there are no comparable sales. The cost approach attempts to estimate either the property's replacement cost or reproduction cost. Appraisers use the income approach to estimate the value of properties that produce income, usually from rent paid on leases. This approach assumes that an investor will purchase a property based on the future income stream the property will produce, the principle of anticipation. This approach also assumes that an investor will not pay any more for a property with a certain income than he or she would pay for a similar property with a similar income, the principle of substitution. Click here if you would like to open this summary as a PDF, which you can then print or save to your device. Chapter 20 Summary. Chapter Conclusion. In this chapter, we have discussed the terms appraisal, valuation and evaluation, the difference between cost, value and price, how to use a comparative market analysis, the three value estimating approaches, how to prepare a comparative market analysis. In the next chapter we'll discuss human rights and fair housing. Now it's time for your chapter quiz. Good luck! 1 of 19. The value of a property as estimated by a taxing authority as the basis for ad valorem taxation is which type of real estate value? Assessed value. 2 of 19. When improvements are continually added to a property with no increase to the value of the property, it is called diminishing return. 3 of 19. While most appraisals seek to estimate market value, the CMA serves a useful purpose to establish a listing price, or range of prices for a property. 4 of 19. What is the most common reason for a property not to be sold? The price was too high. 5 of 19. The value of the property used for ad valorem taxation is called assessed value. 6 of 19. Ian appraiser is assessing Ryan seller's property using the sales comparison method. Which of the following statements is false? Ian's first step will be to estimate the potential gross income of Ryan's property. 7 of 19. Noelle Value is appraising Bridget owner's apartment complex using the income approach. To determine her property's annual net operating income, Noelle must subtract the operating expenses from the effective gross income. 8 of 19. The list of properties sold should include similar properties that have sold within the past 3 to 6 months. 9 of 19. A property sold for $185,000 and is producing an annual net operating income of $16,650. What is the capitalization rate? 9%. 10 of 19. Which of the following problems would be an example of incurable depreciation? Non-air-conditioned office complex. 11 of 19. Which of the following is not a consideration when doing a residential market analysis? The value of the property's land. 12 of 19. The sales comparison approach is based on what principle of value? Substitution. 13 of 19. The highest price a buyer is willing to pay and the lowest price the seller will accept for a property is known as what? Market value. 14 of 19. Tim and Sue have the smallest home in the sought-after neighborhood. The value of their home is increased because of the higher value of the other homes in the neighborhood. This is an example of what principle? Progression. 15 of 19. If a comparable has a feature that the seller's property does not have, the licensee will subtract the value of that feature from the price of the comparable. 16 of 19. A licensee should keep in mind that the information on pending sales is not as reliable as on sold homes, because the price the licensee sees is only the listing price, not the sales price, and the sale is not final. 17 of 19. The value of a property that has reached the end of its economic life is called the salvage value. 18 of 19. Which of the following would not be found in a competitive market analysis? Recently remodeled homes. 19 of 19. What is the last step in the cost valuation approach? Add the land value to the depreciated cost.